So getting back to our 4% number that I want you to etch in your brain. 4% again is the number, 4% is the number you need to make sure that you're not cannibalizing your portfolio. Now, if you look back and remember at 0 to 2%, again, that's pretty par for the course, you're having to sell shares. So at 0 to 2%, to survive on your portfolio with that kind of a growth strategy, you have to sell shares to be able to maintain your lifestyle, right? And that's bad. But here's the real clincher. Are you ready for this? So there's something called SWP, right? The big misconception, systematic withdrawal plan. And the big misconception is that most seniors think you're supposed to have your assets, right? This circle represents your assets. And they think it's like a pizza where you take a slice until what happens? It's all gone. Now, income is the outcome. If you don't have that income, you're just a homeless person on the street. So generating income consistently throughout your retirement years is key here. So this strategy, taking a slice and a slice and a slice, that's called a systematic withdrawal plan, where again, you're essentially cannibalizing your portfolio just to survive. That's the exact opposite of something called DCA, dollar cost averaging, where essentially you're doing that in your 401k, your 403b, your 457s, maybe your Roth, where you're putting a chunk of money away every month, and over decades, you're still throwing money into that account. You're basically buying more shares at a lower price once the market corrects, and that overall drives the prices down, right, of your shares. So DCA we like, SWP we do not like. So this is a bad enough strategy as it stands, right? It hasn't worked for retirees since the dawn of time. It doesn't work now. However, it gets really hairy when markets go down. So I think everyone out there would agree that the market goes up and down, right? I think everyone would agree with me on that one, much to their dismay. But with that in mind, understand in some cases when you're going up, yes, you're taking a slice and a slice to survive over time. That's bad enough. But in a down market or towards the bottom of a market, you're not taking one slice, you're taking 2 or 3 slices at a time. And you're basically cannibalizing your portfolio even more at a more exponential rate. Why? Let's take this example. Let's say you have 1 share of a stock at $10 for 1 share. Let's say it's Wells Fargo. I think that's around that point right now. So at Wells Fargo, $10 for 1 share. And let's say it drops with a market correction of 50%. 50% of 10 is 5, right? Are you guys with me so far? If you're not math lovers, I'll talk you through it, don't worry. So you've lost 50% once the market corrects, 10 to 5. You call your broker, you're upset, he says buy and hold, you'll be fine. But what he's not telling you is when this $5 goes up 50%, 50% of 5 is $2.50. So now you're only at $7.50, not the original $10 that you started with, which can be absolutely catastrophic knowing you have to invest 2 or 3 times as long to get right back where you were. That's fine when you're young, but it doesn't work when you're near retirement or a retiree, right? Knowing that an average market turns about every 6 to 9 years, I mean, do the math. Right now we're in 2018 when I'm recording this. 2009 was the low point. We're due for a big market correction, but that's that aside. Knowing that's the case, when you're younger, understand you have time but not money. When we're older, we have money but not time. So you don't have the luxury to see this rebound. You don't have the luxury at that time to be able to live on your assets with a growth strategy to be able to survive. You're cannibalizing to survive, and that's not a good thing. That's a slippery slope, as we've discussed here. So what's the secret to get away from this mentality, right? The mentality that probably 90% of advisors have out there. Well, if you look at 2 different pies as an example, right? We need to make that paradigm switch and go from a growth to income strategy, as we mentioned before. So if you have pie A and pie B, pie A has $1 million in it, and pie B has $500,000 in it. However, pie A can generate $20,000 a year, and pie B can generate $30,000 a year. Which would you rather have and why? So if you're smart, you're going to pick the one that can generate more money, $30,000, even though it has less in assets, versus pie A, where you have $1 million but can only generate $20,000 each year. Because eventually, over time, you're going to be able to generate more money over a longer period. You would be surprised how many people pick A and not B, because they just see $1 million, they think that's bigger, badder, better. I guess as Americans, that's ingrained in us. And they think that pie A is the way to gravitate to, but really it's about how much money you can generate consistently, not about how much you have in assets. Again, going back to this very example. The best way to personify this or put this in perspective is using a metaphor of being a chicken farmer. As comical as that sounds, by being a chicken farmer in your 20s, your 30s, your 40s, you're trying to fatten up the chicken. But by the time you hit about 50 or so, you want to make a transition and you want to be able to live on the eggs and not cannibalize the chicken. And if you pass, you want to be able to leave that chicken to your kids or extended family, whatever. So again, it's better to have the consistency in income, not necessarily have more money, if that makes any sense. So it's almost like what we're doing here in terms of an income strategy is we're trying to structure your portfolio similar to a rental property, in that regardless of what happens with that rental property, even though the market value, the capital appreciation, the value of that property may fluctuate 5 to 10%, whatever, it doesn't matter because you're going to get the $1,000 consistently each month from the rents, right? And that's essentially what we're doing without having to do things like, repair the roof, fix the plumbing, mow the lawn, deal with tenants, evict people. So what we're doing essentially is using that as a business model on some level, where we're taking the structure of your portfolio, having it modeled after a rental property. So again, getting away from the 0 to 2% growth strategy, we're getting interest and dividends. 4% we know we need. If we can get double or triple what the best that others can do on a growth strategy, I think you'd agree you'd be much better off in that capacity, getting that consistency in income once you're able to make that paradigm switch. That's essentially all we're doing here. I hope this demonstration has been helpful. We look forward to working with you. Please give me a ring at the office or drop me an email or call me if you have any questions about this material. At our firm, we're big believers in two things: transparency and education. And we like to explain the strategy that we utilize and make sure you understand our thought process. We don't just pick up a card that has 4 options and say, what's your risk tolerance? And then shove you into a mutual fund. Every one of our portfolios is like snowflakes in that they're all different. It's going to be completely subjective. It's based on your particular needs, your particular goals, and only based on an adult conversation we have together, what your goals are, what you need the money for, when you need the money, how much you think you need, how much you need to stay liquid, background on your parents, your grandparents, what's your family longevity like. Only then do we take those factors and put them into play and make a mutual decision about what assets to go into. And the beauty of it is we're not a captive agent. We can recommend any product under the sun. We're completely independent, so we're not limited like some of the bigger firms are. I hope this has been helpful, and I look forward to speaking with you soon. I wish you the best of luck. Happy investing.